There's going to be a huge fight in Congress over the deductibility of state and local taxes because in some states, taxpayers can't deduct all the taxes that they incur on their federal tax return. Let's talk about what's going on and what it means for you as a taxpayer. Okay, what I'm going to do to put this together is look at the tax forms and the instructions for the tax forms to start to explain why this tax deduction limitation is a real problem. So these are the instructions for Schedule A that we'll see in a minute. And on line 5, which you'll see in a minute, the deduction for state and local taxes is generally limited to $10,000, $5,000 if married filing separately. So there is a limit on the amount of state and local taxes you can deduct in your return. What does that mean practically? Well, if I go over to Schedule A, here's Schedule A, itemized deductions. If I go down to line 5, this line is limited. You can see right here, the smaller of line 5D or $10,000. So there's a cap on the amount you can deduct. Why is that important? That's important because when you go down and get your total itemized deductions and you go over to 1040, which is your income tax return that we all file, and you look at the itemized deductions section, you're going to see that there's a limit on the item, what you can itemize. So you go down here, we have all the income that comes in, and then down here on this line, standard deduction or itemized deduction from Schedule A. So what goes on this line is what's on Schedule A. What we're saying is that that itemized deduction is going to be smaller if you can't deduct all your state and local income taxes. That's the issue. So when does this tax deduction situation change or end? Well, SALT, state and local tax deduction, was passed when we had the Tax Cut and Job Act earlier in the first Trump administration. You'll see here at the bottom that the law is set to expire after 2025. So there were lots of tax law changes, and one way the legislation was changed to increase flows into the federal government was to reduce the amount of state and local tax that were deductible. So in exchange for offering certain types of tax cuts, the SALT limitation was passed to make up for these other tax cuts. So which states have the biggest state tax burden? Well, this is from H&R Block. The states with the highest taxes are California, Hawaii, Oregon. You'll see a list here. Residents pay 8% or higher on the state income tax. So if you can imagine, for example, that you have $100,000 in taxable income and you're in a state that charges 13% state tax, which some do, that's $13,000. That is above the $10,000 limit, which means you don't get to deduct all of your state and local taxes. That increases your tax liability, it increases your tax burden. So what's the takeaway here? Well, for one thing, if you're a politician who's in a state with a high state tax rate, your residents are angry that they can't deduct all their state and local taxes. You are under pressure to try to get Congress to remove the limit on state and local tax deductions. That's one thing. The other thing is, don't be surprised if you're in a high state tax bracket when you do your tax return this year that some of your state and local taxes may not be deductible.